Welcome to AI World TV, your go-to destination for everything artificial intelligence. Discover the captivating landscape of AI, where advanced technology finds real-life application. Subscribe to AI World TV for webzine articles, reports, podcasts, videos, live events, and latest trends. Hear from top industry leaders and discover how AI is transforming industries and our daily lives.
If you've been anywhere near the financial news, or, let's be honest, if you've just glanced at the NASDAQ Q lately, you know the last week was, well, a bit of a cold shower for the market.
A bit of a cold shower is putting it mildly.
Right. I mean, we're talking about huge, dramatic headlines, volatility everywhere, and the immediate question everyone is asking is this it? After 2 years of this incredible growth, is this the moment the AI bubble finally bursts?
It's the right question to ask. The turbulence was profound, and the market reaction was severe. We saw global markets slide roughly 4% in a single trading week.
Which is the steepest weekly drop we've seen in a long time.
Exactly, since those early days of inflation anxiety. And you're right, the AI sector got hit the absolute hardest. We're talking about the big NASDAQ Q names, the darlings of the boom, losing anywhere from, say, 2.7% to 8% in just 5 days.
Just to put some names on that, Nvidia was down, what, over 3%, and AMD was almost 5%.
Nvidia was down 3.2%, and AMD closed the week almost 5% lower.
Yes.
These are staggering reversals for companies that just weeks ago seemed immune to gravity.
And that's the central puzzle, isn't it? That's what we need to solve today. Our mission, looking at the analysis from the AI World Journal, is to really pull apart this mix of signals that triggered all this anxiety.
Exactly. It wasn't just one thing. We have to look at the macro pressures, the geopolitical worries, and this quiet but growing shadow of corporate debt that was looming over everything, even when earnings looked great.
Okay, let's start with that paradox, because it's so counterintuitive. How does a market full of companies reporting record demand just suddenly hit the sell button?
It's a classic case of sentiment, just completely outweighing the fundamentals, at least for now. And the trigger for the emotional slide, it's fascinating. It was news about approvals for significant AI tech sales, specifically these massive infrastructure deals with buyers in the Middle East.
Wait, hold on. If I'm an investor, I see huge multi-year contracts being signed. That sounds like proof of demand. That should send the stock up.
In a rational market, yes. It should. That news signals long-term revenue. It signals diversification. But we are not in a purely rational market right now.
Clearly not.
So instead, that news just amplified existing anxieties. It immediately raised geopolitical red flags for institutional investors. Things like cross-border tech transfers, regulatory risk, future supply chain problems.
So instead of a revenue win, it was seen as a complexity win. And nobody wants complexity right now.
Investors hate complexity. So the market used a piece of fundamentally good news as an excuse to panic. It confirms the problem wasn't the company's performance. It was the entire macroeconomic backdrop.
So what were those macro pressures? What created this intense risk-off mood?
It was really a perfect storm. First, you have this persistent global inflation uncertainty that just refuses to go away in the big Western economies.
And that drives up the cost of capital.
Precisely. It hurts high-growth companies that need to borrow cheap money to expand. Then second, you have renewed tension around geopolitical issues, especially with semiconductor supply chains and energy costs.
And the third factor was the Fed, right?
Absolutely. We got this very cautious, very non-committal guidance from central banks, and that immediately fuels anxiety about a possible December rate decision. The moment interest rates get uncertain, investors start trimming their winners.
Especially the ones with those sky-high valuations.
Yes, the ones priced at 50, 60, even 80 times earnings get hit the hardest. Their future growth certainly gets discounted by a much higher interest rate.
Okay, so this brings us to what the journal called the resilience paradox, which I found fascinating. You'd assume the companies literally building the engine of AI, the chip makers, the data center firms, they would be the safest bet.
But they weren't. That's the twist. It was the legacy software vendors and the big diversified consumer tech names that actually showed more resilience.
You mean like the big cloud providers or enterprise software giants?
Exactly. The ones that are integrating AI, sure, but their core revenue comes from established diversified services.
So why were they safer?
They're simply less exposed to the specific cycles causing all this uncertainty. The pure-play infrastructure firms are just so deeply tangled in the huge capital costs of data center builds, the GPU supply issues, the chip cycle volatility.
I see. So the diversified players have that consistent subscription revenue, the sticky income.
That's it. It stabilizes their financials. Their value isn't just pegged to this hyper-aggressive spending cycle on the next generation of chips. And in a volatile market, being less exposed to that feels a lot safer.
So the stability of old school cash flow suddenly became more attractive than explosive growth potential. It sounds like the whole thing is driven by this fog of confusion. The market is just hunting for a clear story.
That's a perfect way to frame it. Analysts are working with this really fragmented set of data. There's no single, easy answer. And that just pushes everyone towards caution. We're just seeing all those conflicting signals.
Walk us through some of those signals. What kind of fragmented data are we talking about?
Well, a few things popped up in the analysis. First, you had softer guidance in certain pockets of the industry, not from the giants, but from, say, specialized AI services firms or some component suppliers.
Okay, so suggesting that maybe demand isn't uniformly strong down the whole value chain.
Exactly. And then there's the hardware itself. We're seeing evidence of rising GPU inventories in some key regional markets.
That's a huge deal. For 2 years, you couldn't keep a GPU on the shelf.
Impossible. They were allocated instantly. So if inventory started to build up, it suggests one of two things. Either demand is leveling off faster than we thought, or, and this is critical, the price points are weakening.
Which would threaten those incredibly high margins we've been seeing.
It raises serious questions about their sustainability. The era of scarcity pricing might be ending.
Wow. Okay.
And then you add specific worries about slowing demand in places like India, which was supposed to be the next massive growth market. So you combine all these ambiguous data points, a little soft guidance here, some inventory there.
And the only logical response for an investor is to pull back.
You default to caution. And this anxiety, it doesn't exist in a vacuum, It spreads.
Right. The AI market is connected to everything.
It's deeply interlinked. We saw currency swings, energy prices hitting data center operating costs, new regulatory proposals popping up overseas. Anxiety in one corner propagates instantly into these high beta AI stocks.
The sources even mention the weird role crypto played in all this. How does a Bitcoin surge connect to an AI sell-off?
It's not a direct cause, but it's a distraction, an indicator of instability. Bitcoin surged, 25% in November?
Right.
When that much capital moves that erratically into a speculative asset like crypto, it just signals that a lot of money is confused.
Okay.
It doesn't know where real risk and reward are. It just adds another layer of volatility and uncertainty to the whole system.
Okay, let's pivot to what many think is the biggest long-term concern here, the debt shadow. I mean, the amount of capital needed to build all this capacity, that's not funded by spare change, it's funded by borrowing.
This is the critical sustainability question. This whole AI infrastructure boom required companies to take on unprecedented levels of debt. They borrowed billions, all based on the promise that AI revenue would scale fast enough to pay it all back easily.
And the market's worry isn't that they're going bankrupt tomorrow.
No, nobody is predicting immediate insolvency. The worry is what we're calling debt anxiety.
So what does that mean? What are the mechanics of that?
The anxiety is about the risk profile getting worse. If AI revenue, and more importantly margins, don't scale exactly as projected over the next 18-24 months.
You are listening to the AI World Podcast, your trusted source for the latest innovations, insights, and trends in artificial intelligence, blockchain, fintech, and decentralized technologies. Each episode features expert interviews, engaging discussions, and in-depth analysis of how AI transforms industries worldwide. Stay ahead of the curve with the latest articles and exclusive reports from the AI World Journal, covering everything from emerging technologies to industry breakthroughs. For more news, global events, and access to AI World Society circle gatherings, visit us at aiworld.tv. Don't forget to subscribe to stay informed, stay connected, and be part of the AI revolution with AI World Lounge. Thank you for listening.
Then those repayment timelines get longer.
And their credit profile gets worse, making it more expensive to borrow in the future.
Precisely. This hits the firms banking on hypergrowth the hardest. Investors are suddenly looking at the return on invested capital for every single new data center and asking, is the revenue coming in fast enough to justify this mountain of debt?
So even though a company like Nvidia says demand is structural and will last for years, the market is focusing on the immediate financial vulnerability.
In a jittery market, fear travels much, much faster than long-term confidence. The possibility that the build-out is outpacing realistic, repeatable revenue. That's what's fueling the sell-off.
Which brings us to the core debate the AI World Journal was trying to settle. Is this a total collapse, the bubble burst, or is it just a temporary, maybe even necessary dip?
Most analysts agree that calling it a definitive bubble burst is probably premature. The better interpretation is recalibration.
A recalibration.
Yes, it's a necessary correction after 2 years of, well, runaway enthusiasm that was fueled by storytelling. The big difference now is that investors are moving into a proof-seeking phase.
That feels like a massive psychological shift. The era of just unquestioned euphoria is over.
It is absolutely over. The market is no longer happy with just projections. It's demanding 3 very specific, tangible things. First, sustained revenue growth, not just one-off spikes.
Okay.
Second, durable margins that actually justify these astronomical valuations. And third, predictable demand and disciplined spending. They want to see that high return on capital.
It's the difference between a great story and great economics.
That's it perfectly. If a company can prove that the cost of deployment leads directly to repeatable, sustainable, high-margin revenue, then this pullback is just a healthy, transitory event, a cleansing.
And if they fail that test, what are the stakes?
Well, if the data disappoints over the next couple of earnings cycles, if demand really does weaken, and if that debt proves harder to service than promised, then this sell-off will be seen as the first real fissure in the AI economy.
It would mean the whole structure, the relationship between spending, debt, and revenue is flawed at these valuations.
Fundamentally flawed, yes. It makes the next couple of earnings reports exponentially more important.
It's not enough to be the visionary anymore. You have to be the disciplined accountant. So let's bring this home for the listener. If you're trying to navigate this, what's the core knowledge to take away from this deep dive?
The source material is very clear on this. The main takeaway is that the market's risk tolerance has fundamentally changed, and everyone needs to adjust.
Let's start with investors. What should they be doing right now?
For investors, it's about critically reviewing your exposure to companies with these highly levered expansion plans. You should be favoring firms that are showing financial discipline now.
So that means looking for those resilience paradox players, companies with diversified revenue.
Exactly. And a clear, short path to generating free cash flow. When capital costs are high, liquidity and stability are just so much more important than unproven potential.
What about for the corporate leaders, the CEOs and CFOs actually running these companies?
Their priority has to shift, and shift radically. It has to be about margin improvement and defending their balance sheets. Slow down that sprint to nowhere, and transparency is absolutely crucial.
Over-communicating, you mean?
Yes. Be much clearer about demand signals, inventory metrics, financial projections. Reduce the ambiguity that's fueling all this volatility.
And finally, what about policymakers and regulators? They have a role here too.
They do. The recommendation is to monitor systemic credit exposure, especially with these complex financing models for AI infrastructure. And keep a close watch on cross-border tech transfers, because as we saw with that Middle East news, regulatory uncertainty just compounds the anxiety.
So this turbulence, it isn't necessarily the end of AI's expansion. It's more like a painful but overdue demand from the market that this visionary growth has to be matched by fiscal discipline.
That's the perfect summary. Anxiety fuels the headlines, but fundamentals will decide how deep this crack actually becomes.
It's a real stress test.
It is. The current market test is revealing the maturity of the sector. The ultimate winners won't just be the ones with the best tech. They'll be the ones who can translate visionary claims into repeatable economics, high margins, manageable debt, while avoiding that over-levered sprint to nowhere.
And that leaves us with a final thought for you to take away from all this. As an AI consumer or as a business leader looking to use this technology, where in the entire value chain, from chip manufacturing to software to the end user services, do you see the most sustainable, repeatable economics actually forming today? The answer to that will likely tell you who the winners of tomorrow will be.
The future of artificial intelligence is unfolding, and it's happening at AI World Week, the flagship global event for innovation, collaboration, and transformation. This flagship global AI event is designed to connect visionary leaders, trailblazing entrepreneurs, and influential thinkers to explore the endless possibilities of AI. Experience groundbreaking technology that redefines industries and inspires progress. Join thought-provoking discussions on ethical AI, digital equity, and the transformative role of technology in our world. Build meaningful connections that catalyze innovation and drive impact. AI World Week is powered by AI World Society, a global movement dedicated to advancing AI responsibly and ensuring it serves humanity. Together, we're shaping a smarter, more inclusive, and equitable future. Continue your journey beyond the event with the AI World Journal, offering expert insights, in-depth analysis, and the latest trends shaping the AI landscape. This is your opportunity to lead, to innovate, and to transform the world with AI. AI World Week. We invite you to join us and embrace the AI revolution.